Hi there, I'm Bev from bookkeepingcoach.net. With over 30 years of bookkeeping and finance, I've seen it all and fixed it all. Whether you're a new bookkeeper or a business owner handling your own books, I know how overwhelming it can get when there's no one to turn to with questions. That's exactly why I created this channel. No more messy books, no more sleepless nights. Just clear, practical advice from someone who's been in the trenches. So hit that subscribe button and let's transform those financial headaches into financial clarity, one entry at a time. Bookkeepingcoach.net. Your questions answered, your business empowered. Welcome back to our QuickBooks Online tutorial series. Today, we're mastering expense tracking, which directly affects your profitability and tax compliance. The way you record expenses could be costing you thousands in deductions if done incorrectly. Today, I will show you a systematic approach that slashes expense tracking time in half. You'll also discover strategies that give you crystal clear insight into where every dollar goes in your business. Recording expenses. Let's start by understanding the three main expense recording methods in QuickBooks. Bills, or accounts payable, are used for expenses not paid immediately. This method creates a liability until paid, appears in your unpaid bills report, affects your cash projections, and provides payment tracking and aging. Checks or expenses are used for expenses paid immediately. This method has a direct bank account impact with no intermediary liability created. It's a simpler process for immediate payments and works well for one-time or infrequent vendors. Credit card transactions are used for expenses charged to company cards. This method creates a liability under your credit card account, requires reconciliation against statements, provides an additional verification layer, and maintains separation between purchase and payment. When should you use each method? Use bills when payment will occur after receipt of goods or services, when you need to track upcoming payments for cash flow planning, when you're working with regular vendors with payment terms, when you want an approval workflow before payment, or when you need to track partial payments. Use checks or expenses when payment is made at the time of purchase, when using petty cash or cash accounts, when making a one-time purchase from occasional vendors, when you need a simplified expense entry process, or when paying immediately with bank transfers. Use credit card transactions when purchases are made with company credit cards. When you need additional approval or review workflows, when you want separate purchase and authorization from payment, when centralizing employee purchases, or when utilizing card rewards or the float period. Let's address some common recording method mistakes. Mixing methods for the same vendor creates inconsistent payment records, complicates vendor balance tracking, and makes your vendor history harder to analyze. Establish a consistent method for each vendor. Using the check or expense method for unpaid expenses understates liabilities on your balance sheet, creates timing mismatches in reports, and complicates payment tracking. Always use bills for unpaid expenses. Recording the same expense twice in different methods duplicates expenses and overstates your costs. This typically happens during bill payment. Use the Pay Bills feature rather than creating a new check, and implement a verification process to catch duplicates. For workflow optimization, develop specific processes for each transaction type. For bills, create a process for bill receipt and entry, establish an approval process when required, and set a regular schedule for bill payment. Use the Pay Bills feature for payment and file documentation methodically. For checks, create a standard operating procedure for check writing, implement a check authorization process, establish documentation requirements, set up recurring check templates for regular payments, and maintain a check register review process. For credit cards, download transactions weekly or use the bank feed. Assign responsibility for coding transactions, establish a receipt collection process, create a monthly reconciliation checklist, and document credit card usage policies. Let's discuss proper expense categorization for accurate reporting. When setting up logical expense categories, use industry standard categories where possible. Align with tax return or Schedule C categories, consider specific industry groupings, and balance detail with usability. Create parent-child relationships for major expense groups. For example, have a marketing parent with social media, print, and events as children. This provides both detailed tracking and summary reporting. Typically, you'll want 5 to 15 main categories with relevant subcategories. Name the accounts clearly and consistently. Avoid vague names like miscellaneous or other. Use a consistent naming convention throughout. Consider a numbering system for easier sorting, and include the account purpose in the name when helpful. When making categorization decisions, consider tax reporting requirements, management decision-making needs, industry-specific analysis needs, and budget tracking requirements. Ask yourself, what's the primary business purpose? How will we use this data for decisions? Would this be better tracked with classes or tags instead? Is this level of detail necessary? Is this consistent with similar expenses? Common categorization principles include grouping by function, such as marketing, operations, administration, separating fixed from variable expenses, keeping direct costs separate from overhead, isolating tax-sensitive categories, and maintaining consistent granularity. One powerful approach is using account, class, and location together. Think of the account as what the money was spent on, the nature of the expense itself, like office supplies, advertising, or rent. The class represents why the money was spent, the purpose, department, or function, such as marketing, operations, or administration. The location shows where the money applies to, physical location or division, like East Region, West Region, or online division. A combined reporting example might show advertising as the what, for the marketing department as the why, and in the East Region as the where. This provides three-dimensional analysis capability, enables matrix reporting across dimensions, and creates flexible reporting options. When handling mixed-purpose expenses like travel with personal and business components, home office expenses, vehicle expenses with mixed usage, or technology with personal and business use, follow these best practices. Document the business purpose clearly in the memo field. Split transactions based on usage percentage, create a consistent methodology for recurring splits, and maintain supporting documentation. Consider using separate payment methods for cleaner tracking. Document your allocation methodology for consistent application, and review split expense categorization quarterly. Let's talk about splitting transactions across multiple categories. This is valuable in several common scenarios. Single vendor invoices covering multiple expense types, utility bills covering multiple locations, credit card statements with various purchase types, payroll affecting multiple departments, receipts containing both deductible and non-deductible items, or insurance covering different coverage types. The benefits of proper splitting include more accurate departmental cost reporting, better tracking of true category spending, improved budget to actual analysis, more accurate tax deduction allocation, and a clearer understanding of project or class profitability. Here's the step-by-step splitting process in QBO. For bills and expenses, enter the transaction header normally. In the line item section, enter the first category amount, click Add Lines for additional categories. Enter each category with the appropriate amount, and verify that the total matches the transaction total. Add a detailed memo for each line explaining the allocation, and save the transaction when it's balanced. For bank and credit card transactions, select the transaction in the bank feed, click the Split button, enter each category and amount, add a description for each split, and verify the total matches the transaction. Click Save and Add to complete. For check transactions, enter the check information in the header, add the first expense line, click Add Lines for additional categories, complete all split lines, and again, verify the total before saving. For consistent vendor splits, create memorized transaction templates, document standard split percentages, Use a consistent allocation methodology and review and adjust templates periodically. To improve efficiency, group similar expenses before entry. Use batch entry for similar split patterns and build a split transaction library for reference. For accuracy, double-check math on all splits. Create a verification step for large transactions. Document your split rationale in the memo fields and periodically audit split transactions for consistency. Common splitting mistakes include mathematical errors in split allocations. Always verify the total equals the transaction amount and use a spreadsheet for complex calculations before entry. Inconsistent splitting methodology. Create and document standard approaches and use the same split logic for similar transactions. Oversplitting minor transactions. Consider the cost benefit of detailed splitting and establish a minimum threshold for splitting. Underutilizing split capability. Identify commonly miscategorized mixed expenses and create training for your team when and how to split. And missing or vague split documentation. Make sure to add detailed memo for each split line and note the calculation methodology or rationale. Setting up recurring bills and expenses can save significant time. Start by identifying recurring expense opportunities. Ideal candidates for automation include fixed monthly services like rent, subscriptions, and leases, utilities and regular services, maintenance costs, insurance premium payments, software subscriptions, regular supplier orders, and membership dues. Look for patterns in your check register or vendor history. Prioritize high-frequency, low-variability expenses, and consider both the amount and timing consistency. To create a recurring transaction, go to the gear icon and select Recurring Transactions. Click New. Template types include scheduled, which automatically creates on a defined schedule, a reminder, which prompts you to review before creating, and unscheduled, where the template is saved for manual use at any time. Key settings include template name, make sure it's clear and descriptive, transaction type, bill, check, expense, the frequency, daily, weekly, monthly, or yearly, start and end optional dates, and vendor and payment information. Expense account allocation, auto create versus reminder option, and custom dynamic date references. Template variations include fixed amount recurring, which is identical each time, variable amount recurring, the amount changes, and partially variable, some lines are fixed and some are variable. Managing and monitoring recurring expenses requires regular maintenance. Review your scheduled list weekly or monthly, and update templates when vendor terms change. Adjust for price increases or contract changes. Verify successful creation of scheduled transactions, and check for duplicate or missed recurrences. Monitoring processes include creating a recurring transaction, register review, setting calendar alerts for high-value recurring transactions, establishing a verification protocol for auto-created transactions, performing periodic audits comparing vendor statements to recurring transactions, and creating a dashboard or report for recurring expense monitoring. When troubleshooting recurring transaction issues, watch for missed transactions, check the schedule and the last created date, duplicate transactions, verify you don't have overlapping templates, outdated amounts, update the template with the current pricing, failed creation, check for inactive accounts or other errors, and inconsistent creation. Verify the server connection and settings. The resolution process involves identifying and documenting the issue, determining if it's a one-time or a systemic problem, making necessary template corrections, creating a manual transaction if needed for missed items, and adding template review to your monthly reconciliation process. Let's discuss managing prepaid expenses correctly. First, identify true prepaid expenses. These are expenses paid in advance for future benefit periods. Common examples include insurance premiums paid annually, software subscriptions paid up front, maintenance contracts paid in advance, professional retainers, lease or rent prepayments, and deposits for future services. Key characteristics are that payments occur before the benefit period. The benefit extends beyond the current accounting period. They're typically over a materially threshold, such as $1,000, and they usually cover multiple months or quarters. To set up prepaid expense accounts, create dedicated assets accounts with the type Other Current Asset and name them prepaid expenses as a parent account with subaccounts by category like prepaid insurance and prepaid rent. Create corresponding expense accounts with regular expense accounts for monthly allocation and a consistent naming convention with prepaid accounts. Create an amortization schedule in a spreadsheet, tracking allocation by month. Calculate the monthly expense amount, document allocation start and end dates, and include transaction references. Note that QuickBooks Online does not automate prepaid allocation. This requires manual tracking. For recording the initial prepaid transaction, create a bill or expense as normal. Instead of coding to an expense account, code to the appropriate prepaid asset account. Include full details in the memo field: coverage period, service or item description, monthly allocation amount, and the number of months to amortize. Pay the transaction normally. This creates an asset on your balance sheet instead of an immediate expense. Attach supporting documentation for audit purposes. The monthly allocation process typically uses one of two methods. The manual journal entry method involves creating a monthly recurring journal entry. Debit the appropriate expense account and credit the corresponding prepaid asset account. Use a consistent monthly amount from your amortization schedule. Include a clear description referencing the original payment. Continue monthly until it's fully amortized. The alternative spreadsheet method involves maintaining an external amortization schedule, creating batch journal entries monthly or quarterly, tracking the remaining balance in the spreadsheet, and reconciling the prepaid account to the spreadsheet regularly. Best practices include creating a monthly reminder for journal entries, including prepaid allocations in your month-end closing checklist, periodically reconciling prepaid accounts to schedules, and reviewing for fully amortized items to remove from the schedule. What's your biggest expense tracking challenges? Have you found some creative solutions for tracking complex expenses? What prepaid expenses have been difficult for you to manage? Share your experiences in the comments below. Make sure you join us next week as we continue on our journey through QuickBooks Online.